Good afternoon or good morning, everyone. Welcome to today's webinar, the Year-End Startup Accounting Checklist, presented by Early Growth Financial Services. This is a webinar that will last approximately 60 minutes, and that includes some time included for question and answer period towards the end of the presentation. We have a questions panel inside your GoToWebinar panel there on your screen. We encourage you to use that questions panel to submit your questions. We'll get through as many as possible during this presentation. Our contact information is in the final slide. If we can't get to your question during the presentation, you can reach out to us afterwards. We're happy to follow up with you. So this is a special presentation. It's brought to you by two of our own here at Early Growth Financial Services, two of our esteemed members of our CFO team based out in the Bay Area. First up, we'll introduce Sirk Rowe. Sirk, please say hello.
Good morning, good afternoon, everyone. Thanks for joining us.
Great, thank you, Sirk. And Alaa Ismail, please say hello.
Good morning and good afternoon to all of you. Thank you.
Fantastic, and thanks to both of you for joining us today. So we've got, it's a checklist. We've got a lot to kind of jump into here. This is kind of an overall review of things to be looking for from the accounting side. So we'll drill down into each of these areas, starting with accounting basis. We'll talk a little bit about cash versus accrual accounting, reconciliation and what that means and what kind of falls under that, collecting accounts receivable, making sure you get those bills paid, tax planning, which is very important, processing payroll, issuing 1099s, and finally taking a look back on the current year and getting everything in order for the next year. So that is an overview of the checklist. And one thing we wanted to say kind of up front is not to wing it. If you have mistakes or hastily prepare all of your financials and, of course, your taxes, that can create some issues. Some log jams with operations. You can affect employee morale negatively. It even end up with a visit from the tax man, which nobody likes. So this is a presentation that reminds you to take the time to make sure everything is done and then it's done right. So we've got Sirk and Alaa here today to kind of go through the higher level bits and pieces of this and let you know what to look out for and what you need to be doing to make sure you've got all your I's dotted and your T's crossed. So jumping right in, and Alaa, we'll start with you, talking a little bit about just the accounting basis in general and the two major accounting methods that we typically see.
Yes, so typically the two bases of accounting that most folks use is either the cash basis or the accrual basis. Just simply put, cash basis recognizes revenues when they're received, meaning cash is received for them, and expenses when they're paid. Very generally, again, accrual basis recognizes revenue when it's earned and expenses when they're incurred. So very early on, a lot of companies are really on a cash basis. So whenever they receive a payment from a customer, for example, they recognize that as revenue. Whenever they pay a contractor or any kind of expense, they recognize it as an expense in that month. The majority of the companies that are in business and have been in business for a while tend to be, or our C Corps tend to be on an accrual basis. Accrual basis is very, very similar to when you hear generally or GAAP-based accounting. Generally accepted accounting principles calls for financials to be stated on an accrual basis. And the best time that you could make sure that you're GAAP compliant is really yesterday. And if you are on a GAAP basis, you need to make sure that you're recording all your expenses for the year in that year. So a lot of times at year end, we don't receive all our invoices from our vendors by the end of the year, so that tends to be forgotten. So to be consistent and to make sure that your books are in good order, make a search at the end of the year and look at the invoices that you receive from your vendors and make sure that you put them in the right time slot in the current year. Same thing on the revenue side. Go through to your your customers, your clients, or whatever your business calls for, and make sure that all invoices to those customers are sent out and recorded in the current year. A good review of that will make your financials a lot more accurate and give you a good set of clean books. When you go out to any kind of a fundraising event, you could feel confident that your books are properly stated and address any kind of questions that may arise. The primary benefit of accrual accounting is that it gets rid of a lot of the lumps that you might see with cash-based accounting method. For example, SaaS companies, a lot of SaaS companies receive subscriptions that are paid in advance. If you're on a cash basis in your SaaS company, you might have, a very, very good subscription month where you're receiving a lot of cash, and then the next month, maybe not as much, and then all of a sudden your revenue goes down. A GAAP-based system will flatten that out because it'll take the revenue that or those subscriptions that you've received and spread them out over the term of your subscription period and make your financials look a little bit more consistent. It's also what a lot of investors look for. So if you're on a cash basis, you're at a little bit of a disadvantage in the fundraising world.
Yeah, and I'll just add a little bit to that as well. I think all those are great points. But if you're ever going to be going after fundraising with external investors, VCs, angel investors, they're almost going to demand that you go onto an accrual basis for a couple of reasons. One, to Alaa's point about kind of the lumpy activity that you see in cash-based accounting, but also because cash-based accounting allows a founder or someone within the company to kind of play around with the books a little bit. Not that you would be doing that in any kind of a negative way, but just for example, just by not paying some of your vendors that are due. If you withhold payments for a month or two, then all of a sudden your cash flow looks a lot better and your financials look better. And so investors want to make sure that that their portfolio companies aren't doing any of that kind of stuff. So they're going to demand accrual-based accounting. And so if you know that you're either going to be trying to find external funding at some point later on, the earlier you can move to accrual-based accounting, the better off you'll be.
Great, and a question we had come in on this topic from one of our listeners: is it acceptable to have above-the-line revenue or cost of goods sold on accrual basis and below the line on cash basis? Have you ever seen anything like that?
Sirk, maybe you could chime in as well.
No,
no
yeah.
I have not.
No, I've never seen that. I don't know why. I'm not sure why anyone would want to do that. If you're going to go to an accrual-based accounting, then to accrue for expenses below the line on an accrual basis is not really that difficult, and you should be consistent kind of throughout the entire income statement.
Right. Now, let me kind of clarify that answer. As a matter of policy, you can't have mixed financials, meaning that you can't go to an investor and say part of our financials are GAAP and part of our financials are cash basis, or to an auditor and say the same thing. Now, in practice, you see a lot of companies do this. They might recognize their revenue on a GAAP basis where they're recognizing revenue as they're earning it. And then their expenses, even though they don't really mean to, they're recording the expenses when they pay them. Because a lot of early stage companies don't have the bandwidth to go back and look at invoices and say, oh, wait a minute, we paid, that was a prior month expense, let's put it in that month as opposed to this month when we paid it. So while it isn't common practice, I've never seen a company formally say that we're on a mixed basis. I do know that in practice that discipline is not always followed.
But yeah, I agree with that, and we certainly see that, especially when we start working with clients for the first time. We do see a lot of that, and that's one of the first things that we try to do when we start working with clients, and that is to get them to be fully compliant and to get their books in order on an accrual basis. So we will kind of go back and try to catch up on expenses and invoices and bills that come in. To make sure that either we are entering in the correct periods, or to the extent that that's just not possible on a regular basis, to make sure that we're accruing for those expenses at the end of the month, even though we haven't actually seen the invoices.
All right, great. Thank you, gentlemen. So moving on here, Sirk, let's talk a little bit about reconciliation and what that typically looks like.
Sure, and again, we're probably talking about companies who are on an accrual basis, and when you are, then obviously doing things like making sure that that any checks that have not been cashed or need to be reissued have been done so, and making sure that our checking account, our cash accounts, and our investment accounts are reconciled is obviously critical. But there's also the bigger issue, or at least the thing that gets overlooked a little bit more often from our perspective, that's just as critical, is making sure that all of the balance sheet accounts are reconciled. And this is where kind of the accruals that are made at the end of every period, and certainly at the end of the year, really reflect the activity that took place, and such to the extent that if accruals for expenses have to be made, that is done. And the way that you see kind of what's going in and out of all of those balance sheet accounts is to do a full balance sheet account reconciliation. And as a CFO who's reviewing the books and financial activity of companies, I probably look at that much more closely than I do at the P&L, because the P&L, or the income statement, is only a part of that. The balance sheet, and really what's kind of eating up the cash, or what's happening with cash, is more a function of what's happening with the balance sheet. And so that's really, really critical, I think, for entrepreneurs to understand kind of what's happening with their business.
Now, do you guys, when you're working with these early stage companies, do you typically see a lot of cleanup in this area when someone hands over, their QuickBooks export or a spreadsheet or a bag full of receipts? Do you see a lot of work that needs to be done in this area from your perspective?
It kind of just depends, right? It depends on how much activity there is, how much past activity has to be reviewed, and really when we start working with clients, right? So if typically we start working with clients, in the startup phase, as they're getting ready for the first investment from investors. Or right after they've received their first investment from investors, and usually at that stage there isn't a whole lot of cleanup to happen. But then I've also seen clients that that have kind of weathered it along for a long time, and have a year of growth that has to be reconciled. In which case, then obviously the level of effort is a lot greater. So it just kind of depends on each separate company. Alaa, do you have any thoughts on that?
So when I first engage with a client, I ask if monthly financials are critical to whatever their business goals are, and typically it's getting a monthly financial, historical monthly financials prior to when we engage, that our GAAP basis is not that critical to an early stage company. So what I do is I typically, in that whatever the trailing year, I just make sure that that year is GAAP compliant, and I do that not so much from a beginning balance perspective. I do it at the end of the month, at the end of the year, excuse me, where we do kind of a proper cutoff. We look at expenses that have been paid, say, in January, and do a detailed review to make sure that they don't relate to the prior year. So we dump all those expenses in the prior year. And then once I have a really good year to start with, then from that point on, monthly or quarterly, we do really good GAAP-based financials with proper cutoffs. So that's in practice what I do, but I'm sure each one of your goals your accountants will help you achieve whatever results you need.
All right, great. So, Alaa, let's talk a little bit about accounts receivable and making sure you're getting paid.
Right. So the one thing that that I kind of tell most of my clients, not just accounts receivable, but your balance sheet. If you're on a GAAP basis, your balance sheet becomes a really, really critical financial statement. And to make sure that your balance sheet is reconciled monthly is really important. The reason is that the balance sheet is where a lot of trouble tends to hide. Remember, the balance sheet is one of the financial statements that is a legacy that goes on from year to year. So as a result of that, there's a lot of problems that tend to hide on the balance sheet, and one of them is accounts receivable. A constant look at your accounts receivable aging and a good effort to collect unpaid bills is just good corporate strategy. And besides that, it also, for early stage company, it gets cash in-house where it's needed. Another kind of intangible is that, like anybody, clients of yours will take as long as you let them sometimes to pay their bills. So if you get into a habit of not following up with your customers for payments, that you'll tend to kind of push your clients to pay you later and later. So if you're diligent in a kind way, of course, with your customers, you'll get them to pay you those unpaid bills or collect those receivables a lot sooner. You should also look at your business and see if there's a process that you can change to get you paid sooner. I hate to keep going back to SaaS, but I go to SaaS companies a lot of times and ask them, why are you still billing your customers? Why aren't you doing, say, a credit card collection process to get the money in? Doing formal collections is really expensive, and any kind of cost associated with, say, credit card receipts far outweighs the related collection cost. So look at the process, your accounts receivable process, and see how you're getting paid, and see if there's a way that you could to improve that, to help improve your cash flow.
Yeah, I think those are really, really great points, Alaa. Automating and staying on top of accounts receivable are critical. When we work with clients, we typically see one, it's really one extreme or the other, right? You either have companies who just have the understanding and the sense of urgency about collecting from their customers, and you see when you look at their accounts receivable aging, it's nice and clean. Everything is either up to date or within the first 30 days of due, and you don't see things that are lapsing beyond that. On the other extreme, obviously, when you look at the accounts receivable aging, and you see accounts that are due, that's kind of all across the board, not only in the current period, but you have accounts from 60 days, 90 days ago that have yet to pay. And some people say, well, our clients, our customers are just not, they're just not very, very good about it. And I'll echo Ala's viewpoint that it's more on us, right? It's more on us and how diligent we are. Because as in a lot of other cases, there's the squeaky wheel that gets the oil, right? And so, as long as we're being friendly, sending friendly reminders, following up with emails, following up with phone calls, that will really pull in, and people and customers will start realizing, look, if I don't pay these guys, I know I'm going to get a call from them on day 25 and day 30 and day 35, and they don't want to deal with that, and so they'd rather pay us rather than being kind of I guess, steeling themselves for those emails and calls that they know are going to be coming, because they're getting those calls from other vendors of theirs, and so we want to make sure that we get paid.
Wonderful, thanks, guys. So, Sirk, one of the spookier topics, of course, is always taxes. So, why don't you tell us a little bit about how some proper planning can help alleviate those fears?
Sure, Jason, and I imagine that a lot of you, this is probably kind of the key thing, end of year planning, making sure the taxes are being filed, paid, and planned for on a timely basis is probably one of the key worries that we have as business owners, and rightfully so, right? Because we can get into a lot of trouble. And so, I think with just a little bit of either research, planning, certainly working with tax professionals will obviously go a long way in easing stress that's associated with taxes. And so that's kind of the first thing that I would say is that you should, if you have a business, you should be working with a tax professional. Trying to do your own taxes and all that's involved in that with regards to understanding deadlines and what needs to be reported, and the best way of filing returns is not an efficient use of your time. Much better to have a tax professional do it. But having said that, understanding some things like ways that we can things that we can do towards the end of the year to help us before we file is obviously going to help us. And so, for example, there's something new just this year, and staying on top of tax regulation and rules is obviously important as well. So just new this year is something that a lot of our clients will be able to take advantage of, and that is this R&D tax credit. So research and development tax credit is something that's been available to technology companies who are developing new technologies. And in the past, companies have been able to kind of to keep track of how much they've been spending, and they use that credit at a later date when they do become profitable to offset future earnings. And that, while it's good, doesn't help a lot of early stage companies who, let's face it, are not profitable for many years. In the beginning, they take investment from investors. They're developing something big. It takes them time to develop the revenue to start offsetting some of their expenses, and it takes many years before they're profitable. Starting this year in 2016, there's a new rule that allows certain companies, technology companies, to use this tax credit that they've earned in 2016 to offset payroll taxes in 2017. And this is a tax credit. It's not a tax deduction, so it's going to be dollar for dollar, in terms of the credit that you can use to offset payroll taxes in 2017. So this is, there's lots of, this being a new rule. There's lots of questions that are still to be answered. A lot of people are doing a lot of research, including our tax team is doing a lot of research, and you can log onto our website and there's a blog about it from our chief tax officer. But it's something that a lot of technologies are going to be able to take advantage of, and so doing a little bit of research, talking to a tax professional will allow you to do that. There's probably other things that, again, looking at your individual tax situation, whether you're making money, whether you're losing money, all those things should be considered, and we want to just make sure that you are, getting the best tax treatment that you can. There's, in terms of things like tax deadlines, there's been a shift that starts this year in terms of reporting. In past years, corporate tax returns were due on March 15th, by March 15th, and then partnership returns were due on April 15th. That switched now, and so LLCs now are due on 3/15, and C corps are due on April 15th. So you should be aware of that. You know, there's other requirements, other filing requirements at the end of the year that you need to be aware of. Obviously, you know, state tax filing. So, for example, in California, even if you have losses and you're not going to have any taxable income, there's still a minimum $800 fee that has to be paid along with your filing, and that's due on April 15th. If you're a Delaware corporation, which many companies aren't, just because Delaware makes it very, very simple for you to be a corporation within the United States, then you should be aware that there is a Delaware franchise tax filing and payment that needs to be also made, and that's by March 1st. And so, obviously, if you're not a California company, if you're operating someplace else, then you need to do research into your own state tax filing requirements. But all those things, you know, the first recommendation we would make is to work with a tax advisor.
All right, great. Thanks, Sirk. Ran through quite a lot there on the tax side in record time, so that was fantastic. And just to follow up, as Sirk mentioned, you know, we've got a lot of stuff on the Early Growth Financial Services blog put together by our own tax team, including a great white paper we recently published on the new R&D tax credit applications for tech startups. So we encourage you to check that out. If you need that link, again, our contact information will be in the final slide of the presentation here. So we're happy to set you guys up with that. So moving along, Alaa, let's talk a little bit about things on the payroll side.
Okay, so the first kind of guidance that I would give anybody is do not do payroll on your own. There is literally hundreds of choices that you have at very low cost out there that will do your payroll. Payroll filings are complicated, and the penalties are fairly severe for not making, for example, correct and timely payroll tax deductions and related payments. So general advice, if anybody out there is doing payroll on their own, stop and find somebody to do that payroll for you going forward. The other thing is that you have to be aware of is that by the end of January, you need to get all your employees their W-2 forms. Typically, if you're with the payroll, outside payroll companies, those W-2s will go out sometime in mid-January to your employees. So make sure that all your employees get their W-2s timely. The other bit on payroll side that you need to kind of take a note on and that you'll need for your taxes is just note that if you have any bonuses, meaning bonuses that were earned in the current year that will be paid either in the subsequent year, and that information is important for your tax returns. And that is essentially it on your payroll. Again, if you have a payroll provider, then they will be aware of all the different tax filings that are required. And for example, there's a annual reconciliation that that is required at the end of the year that reconciles the quarterly payroll tax returns to the annual number. And again, that payroll services will do that for you if you're signed up to that service. But it's something that you as an individual doing that may not be aware of. So on the payroll side, you know, I've stressed it 3 times, get a payroll provider to help you.
And also, just to kind of touch, we mentioned at the beginning of the presentation, you know, some of these issues could be, you know, with employee morale. The W-2 is quite the sticking point. You know, in a past life at a previous job, I've worked at a company where W-2s started creeping out a little bit later than they should have, and that can get employees fired up pretty quickly. So keep that in mind. You know, from my own experience, I've seen it myself. You know, keep that in mind as you're getting that stuff prepared. People are expecting the W-2s that getting issued to them in a timely manner so they can turn around and start working on their own personal taxes. So Great. Payroll, it's always very important. So is issuing 1099s for your contractors. So, Sirk, let's talk a little bit about that.
Sure, just a brief introduction on 1099s, because we always kind of get the question of, when do we send it out? Who do we send it out to? What are the requirements? And typically 1099s are similar to W-2s in that it's a way of reporting that you paid somebody something, but it's not an employee. So typically these are for individual contractors, who may be doing some work for us. We may have hired people to do some work on our behalf, and we're not withholding taxes from them. And so this is a way of both reporting to the individual that, hey, we paid you some money, which means that you're supposed to report it to the IRS. And then obviously we report that to the IRS that we made this payment to these individuals. And so this is the IRS's check to make sure that they're getting paid their taxes from everyone who's making money different ways. And so the requirement is to issue 1099s to individuals for whom you have paid for services rendered in a given year of $600 or more. So if it's for less than that, if it's for one person who kind of did a little thing and you spent $100 or $200 during the year, you don't have to send them and file 1099s. But if you paid someone more than $600 in a given year, it is a requirement that we issue 1099s to these contractors and that we report that to the IRS. And I will tell you that the penalties can be pretty significant, because the penalties are on a per instance basis. So if we just kind of fail to submit 1099s and we get audited by the IRS and we're found that we failed to submit 1099s, it could be a pretty substantial penalty. And I've seen companies go through that in the pain. And so just make sure that you're aware of that and that this is not something that you fail to do. So what you have to do to obviously file 1099s and to give 1099s to employees is you have to have their information. And the way that you do that is you collect a form, a W-9. Along the way, as you start working with contractors, you send them an empty W-9, or you ask them to fill out a W-9 and send it back to us. And the W-9 is basically a declaration as to obviously their tax IDs and information. And it's also a place where they would state whether they're liable for 1099s or not. C corporations, for example, are not. You don't send 1099s to C corporations. So the safe thing to do is basically anyone that you're doing business with, you ask them to submit a 1099, you have it in your records, and at the end of the year, you kind of go through and you figure out who should be sent to 1099, and you do it. The deadlines for filing is to actually send the 1099s to each individual by January 31st, and then we're supposed to submit the filing to the IRS either by February 28th or March 31st, depending on whether we're doing it by paper or by electronic means. But again, it is something that a lot of companies, we find, they kind of scramble at the end of the year, right? They kind of scramble because they haven't kept up with their W-9s along the way. They don't know who they need to send 1099s to. They don't know how to contact them. They don't know where to send 1099s to, even if they do have a kind of a name or names that they know they need to send it to. And so, for us, especially when we work with clients for the first time in a given year, this is usually a scramble to get all that information. And the best thing to do is throughout the year is to kind of stay on top of it, make sure that we have the paperwork in place so that when January comes around and we see, okay, here are, we can do a list of all the contractors for whom we spent more than $600 in the previous year, and here's all their information. We can check off whether they're subject to 1099s, and it becomes a smooth process. As opposed to if we haven't kept up with that, then it becomes a mad scramble in January to get all that information, reach out to contractors, get them to file, to get them to submit a W-9 to us, and get the 1099s out by the deadline. So, try to stay in front of that. This is a great time of year to kind of go back into our records for 2016. And if we haven't done so already, then this is a great time to start catching up and start doing the paperwork that's required for us to be able to submit the 1099s on a timely basis in January.
So, Sirk, you dropped the capital A on us, audit. So for anybody, I'll throw this question to you. If anyone's sitting there that is starting to freak out that maybe they didn't submit 1099s for the previous year, is there any way to kind of backfill that, or to kind of cover their bases, or are they just kind of stuck at this point in the event of an audit?
Well, I think there's always time to amend the return. However, the further along you go, the more difficult it becomes. Typically, I have not seen many clients of mine get any kind of answer or any kind of letter saying that there's something deficient in your 1099 filing that is more than 2 years after the date. So if you're 2 years down the line, or if you're a year and a half down the line and you have not heard anything from the IRS, then I think you're in pretty good standing. Now, if you have a significant exposure, my guidance, and meaning that there's a ton of 1099s that you haven't filed, my guidance is to contact a professional, get things amended, and file the proper returns. Doing things properly will at least minimize whatever kind of penalties that might come down the road. So to the extent that you could fix things, and it's material number for you, I would do that sooner than later. However, if you're 2 or 3 years down the line and you discover, maybe 1 or 2 of your vendors didn't get 1099s, this is probably off the record, but I would not, going back and doing a restatement probably is not a huge exposure item for you. But if it's something significant, always the best thing to do is always to do things properly and go back and amend and file the proper returns.
Yeah, there's the legalese and obviously the practicality of certain things. To Ala's point, and the penalties do increase over time. For example, if you're late by 30 days, it's a per instance of $50. If you're late beyond that, I think it goes to $100 or $150, and if you're late up to a year, it goes up to like $200 or $300 per instance. So it can get substantial. And maybe I'll differ a little bit from Ala's standpoint, and maybe I'm being a bit of a stickler here. But if it turns out that you're really worried about it, that you need to go back 2 and 3 years, and that you haven't done it, and it's kind of been sticking in the back of your mind as a stress point. I would talk with a tax professional. And explain the situation. The right answer may be, hey, look, we've got some decent exposure here, and probably the best thing to do is to get in front of it, and maybe we can talk to the IRS, because there's something to be said for kind of fessing up without being hounded by the IRS first, and called for an audit or called for questions to say, look, what, we need to amend previous year's filings. We didn't file 1099s. We want to do that. We want to catch up, and we want to talk with you about possibly lowering any penalties. So that's another way to go as well. I guess each of us individually have to determine kind of the risk profile that we're willing to live with, and make the best determination.
Okay, great. That's fantastic. Alaa, I'm going to throw this next one to you here on just reviewing the current year and then putting together a plan for next year, and then we'll jump into some questions here. So Alaa, just take it away.
Okay. So, you know, now that it's the end of the year, this is the time to kind of sit and take a reconciliation of the prior year and then to figure out what's going on for the next year. So, you know, I'm a firm believer in forecasts or budgets. This is a great time of year for you. If not now, it should have actually been done earlier. Is to look at the goals and milestones that you've set for the prior year, adjust those goals and milestones for the coming year, and from a financial side, do a new financial forecast that lays down a guide or a path for you in the coming year. Forecasts are great tools for business, but they have to be current and they have to be updated and they have to be relevant. So by taking this time to kind of look at your prior year performance and then readjusting your goals and forecasts for the coming year, that is a really, really good practice, best practice for you to do at this time. One of the critical things that might come out of there is that now you have a year of history that you could look at. Look at your cash burn situation in the prior year. A lot of early stage companies, unfortunately, are in a cash burn as opposed to a you know, cash positive situation. So look at your prior year cash burn and then adjust for next year and to see, you know, are you going to make it through the next year or the next quarter or whatever the next milestone is. That is really, really critical to get ahead of that. If you're in a raise situation, I want to tell you that that time process is a lot longer than you might think. So if you're, you know, 3-4 months out from getting to a critical cash position, it's not time now to do something about it. Figure out the last year of how things went. You know, internal controls. Are you having a lot of vendors bother you for payments because you've never received invoices? So, or are you double paying invoices, or are you not billing your customers properly? This is a good time to look at how you're functioning as an organization, your back office accounting needs and the related internal controls. And now is the time for you to go back and fix that situation by you know, improving your process or changing your process. Again, an outside help of you know, somebody like Early Growth or an outside accountant could really help you and establish what those internal controls can be and what best practice policies and procedures are. You know, the part of the budgeting process and the forecasting process is also looking at the stakeholders. Don't do it if you're a leader, a CEO, or a founder of the company. Go and look at go and meet with your department heads, with your financials, and look at plan for next year, and, you know, get those folks involved in the budgeting for next year. If you have investors, your investors will probably have a regular cycle of reviewing your financials. So doing that with your team and having all that planned out prior to meeting with your investors will make you look a lot better in front of your board of directors and your investors, and also you know, instill a good financial planning and financial management process with your management team. So those are the kind of the general kind of non-direct financial year-end taxing, year-end financial and tax planning that you need to do at the end of the year. It's just a good time to reconcile a lot of different things in your financial management.
Yeah, those are great points, Alaa. You know, most startups, right? You know, it's if you're in your first year, or if you've you know if you've been in business for less than a year, or maybe between 1 and 2 years, at the end of the year, things look very, very different than they did at the beginning of the year. So doing that kind of comparison of how did we do compared to how did we think we were going to do at the beginning of the year or when we first started is really, really critical. It's also obviously a time when again, because of changes, we may have grown, we may have hired a bunch of people, our processes may not have caught up. Maybe in the beginning, one person was kind of doing everything, including, entering invoices into the system and paying them. Well, that's not a bad, but it's we prefer the checks and balances in place such that the person who's actually entering invoices into the system is a different person than the person who actually pays it. You want to have that kind of separation of duty. And in the beginning, maybe you didn't have that, and now's the time to put that in. Maybe we've got now a lot more transactions because again we've grown. We're working with more vendors, we're seeing more bills coming in. In the beginning, maybe people were just sending those to us by email, and we were kind of logging them into our system ourselves. And maybe now is the time to put in something like a bill.com process so that things like making payments are more automated. In the beginning we might have done payroll by ourselves because we thought that was the best way of doing it and we wanted to save money. And so again, this may be a time to move to a payroll service provider if we're not using one. The final thing that I'll add, and again kind of more critical towards startups who are ultimately going to be either they already have investors or if they are going to be looking for investment for the first time in the new year. Obviously the financial planning and budgeting is critical. But the other thing that I'll say is really think through the milestones that you've hit in this previous year. Highlight those and really think about what milestones do I need to hit in this upcoming year for me to continue the success of the company and to continue our ability to raise additional funds at higher and higher valuations, because that's really what it's about for a lot of the startups that are going for investment. They're going to be getting multiple rounds of investment. We're kind of at the beginning stages. It's going to be a long time before we're profitable. Investors know that. They want to know that we're hitting the milestones that we need to hit so that we're going to be successful long term. And so highlight the things that you did, see where we went wrong, see where were the delays, what can we learn from it. Let's roadmap what we're going to do in this upcoming year. Put those milestones on paper, couple that with kind of the financial plan that's required to get us there. See what that does to our cash and our cash burn, which will obviously back us into when we need to raise money, how much money we need to raise, and when we need to start that process. So all of that stuff, really, it's impossible to do on the fly, right? It needs to be planned out, all in kind of in one big effort. As opposed to just saying, well, let's see how things go for the first couple of months and then see where we're at and look at it again. This is the time of year to do it, especially if you're going to be looking at fundraising in the coming year.
Awesome. Thank you very much, Sirk. That was fantastic. So as we go into the questions here, just a quick note. One of our clients just fired up the bat signal, so Alaa had to step away. So Sirk, you and I will be bringing this home. So we've got a few questions that have come in. As a quick reminder to everyone that you can use the questions panel in your GoToWebinar console to ask questions about the startup checklist. We'll get through as many as possible. If we can't get to your question today, our email address is right there on the screen, so we encourage you to reach out to us. Our website is listed there as well, the shorthand version, so you don't have to type all of that out. Sirk, let's jump in real quick. Out of the items that you saw in there in the checklist, what seems to be the one area where most startups and most entrepreneurs seem to trip up the most? Do you have a particular area or a couple areas where founders just seem to forget it or not get it right or kind of stumble over themselves throughout the process?
Yeah, we see kind of, across the board, right? So the 1099s is a big gotcha for some entrepreneurs who, aren't working with an accounting professional and who aren't, who isn't been given that counsel. We find the Delaware franchise tax filing not being done. That's one where it's like we get these notices, right? We get these emails from the CT corporation out of Delaware saying, "Hey, you need to file these filings," and it kind of looks like it's kind of spam, right? It looks like someone trying to make money on us, but it is an annual filing that, again, because it's annual, because people aren't thinking about it on a regular basis, it kind of gets missed. And so, by March 1st of every year, you're supposed to do the filing. It can be done online if you're a Delaware corporation. You need to file and you need to pay the fee that's associated with the annual filing. So that gets missed a lot. And then, the big one, and obviously, we see this I guess, dynamic where, initially when companies first get founded, obviously cash flow and minimizing cash burn is of the utmost paramount concern. And so founders kind of try to do everything they can by themselves. And I will say that, one of the biggest mistakes that founders can make is not focusing their attention on the things that are critical to the success of the company. And for a startup, it's usually product development and customer acquisitions, right? Those are the two main things, and that's what founders and executives of startups should be focused on. All this other stuff are concerns that are going to creep into your head, filings that have to be done, worries, stresses of notices from organizations that, in my estimation, are better left to other people. And so things like, making sure that bills are getting paid on a timely basis. You know what? Set up bill.com. The cost is so cheap compared to the ease of work and the level of effort that's required to get things done. The value is so much greater than the cost. Just do it. It just makes a lot of sense. If you're not using a service provider, get a service provider. If you try to do taxes on your own, get a tax service provider. Those are the kind of the key things that I would say to kind of like that first year startup, and making sure that they stay on top of that in the new year. But kind of bigger than that, I think, is really this idea that the last point that I mentioned, which is really thinking about kind of the plan for the next year, the milestones that we're trying to achieve. Because that is, without milestones that we're trying to achieve and strive towards, I think it just makes it very, very difficult for us to tell a compelling message to investors as to why they should be investing in our company versus someone else who has thought through all those things and can communicate that effectively.
So you mentioned 1099s briefly there. We've got a couple questions come in. I'm just asking for the deadline again, to mention the deadline for filing 1099s.
Sure. The deadline for issuing the 1099s to the individual contractors is January 31st. The deadline for filing with the IRS depends on whether you're filing by paper. If you're filing by paper, then the deadline is February 28th. If you're filing electronically, which at this point now everyone should be filing electronically, then the deadline gets extended to March 31st.
Okay, great. Thank you for that. Now, for, again, another 1099 question, how do you record deferred legal fees? So does a 1099 apply to your legal counsel?
Yes, absolutely. All lawyers, regardless of how they're set up, need to be given 1099s. And the actual 1099s are for payments made, right? So if you're on an accrual basis, then absolutely, that's a great question, because at the end of the year, you're going to be making an accrual. But for 1099 purposes, it's about the actual amount of payment that was made. So you just kind of go back to your QuickBooks or wherever you're keeping your records, and you figure out what the payments were made to your lawyer, and that's the amount that gets stated and reported.
Okay, great. I think we've got time for one more question here. It's around the accounting basis. Should I wait to the beginning of the year to switch from cash to accrual-based accounting, or does any time work?
No, any time works. And kind of talking about that, so we talked about what some of the benefits are of accrual-based accounting, and we're certainly big proponents of that. Because it really does truly reflect the financial condition of the company at that point in time, as opposed to cash-based accounting, which can skew things depending on when we receive cash or when we pay out cash. But there isn't any need to wait until the end of the year. You certainly can. In which case, then you might do one tax filing for the year under a cash basis, and then switch to an accrual starting on January 1st. But that requires, I guess in my estimation, unless there is a business need or a business benefit to doing that, then there's no reason that you need to wait until the beginning of the year.
Okay, great. Thank you very much, Sirk.
I would say if you know you're going to go to accrual-based accounting for any reason, and typically that has to do with ultimately finding investors for your company, because like I said, investors are going to require it, demand it, then the sooner the better.
Okay, nice. Well, Sirk, I think that's a good stopping point. As a quick reminder to everyone, a recording will be made available to you within 48 hours, and we'll also have this up on our YouTube channel for Early Growth Financial Services, so you can check it out there. Alaa, we'll thank him when we talk to him again, but Sirk, thank you for joining us today.
Thank you, Jason, and thank you everyone for attending, and happy holidays.
Yes, happy holidays, everyone, and we'll see you next time. Thank you.